This is Michael Martin, President of ECFA. It's my privilege to welcome you to today's special ECFA webinar on what's new for nonprofits in the Consolidated Appropriations Act 2021. Thank you so much for tuning in, especially during these busy times. This is an important week in our country as today we celebrate the life and enduring legacy for racial equality of Reverend Dr. Martin Luther King Jr. And as we keep this nation and our leaders in prayer with the presidential inauguration this week. As our special guest presenter on today's webinar, we're pleased to welcome back CPA and ECFA board member Michael Batts from Orlando, Florida, who is one of the top experts in the nation on this topic. As I'm sure we've all experienced and Mike will underscore during the presentation, this is an ever evolving topic, but we're working hard to share the latest and best information as we know it today. Speaking of which, today's presentation will largely be guided based on the webinar handout available on the GoToWebinar control panel. We'll plan to show the handout during Mike's presentation, but also encourage you to take time now to download the handout and keep it for reference. And again, note that the information on the handout is current as of today, January 18th, and is likely to change. We encourage you to regularly visit ecfa.org/COVID-19 for the latest news and information, as well as the COVID-19 page from Batts, Morrison, Wales, and Lee at nonprofitcpa.com. Well, without further ado, I'll now turn today's presentation on what's new for nonprofits in the Consolidated Appropriations Act 2020 over to our friend and special guest presenter, Mike Batts.
Thank you very much, Michael, and hello to all of you in ECFA land. It's great to be with you today. We are certainly in unprecedented times, and these times are unprecedented in so many different ways. But one of the ways they are unprecedented is that we are looking at the most massive governmental stimulus and relief packages that have ever been passed in the history of the United States, and they're still coming. The most recent example is the Consolidated Appropriations Act of 2021, which was the major annual budget legislation passed by Congress and signed into law on December 27 of 2020. This massive new law, which was more than 5,000 pages in length, included a section that provided major new stimulus and relief provisions for businesses and for nonprofit organizations. And there are some major implications and potential opportunities in this legislation. As Michael indicated, it would be extremely helpful for all of you who are tuned in with us today to download the webinar presentation, which is labeled the Handout CAA Summary. It's available in your control panel. If you will download that, have it available in front of you. You might want to print it out to take notes, but we're going to be talking off of that today, and we will not be following slides. So, and we have line numbers on the PDF to help you follow along as we move forward. So let's jump right in here. We're going to talk first and foremost about the two biggest changes in the law from this CAA, as we call it, this act, the Consolidated Appropriations Act. The biggest thing is that there are retroactive changes to the Paycheck Protection Program loans, the rules related to that for the original PPP loans that were already taken out. So there are some retroactive changes there. There's also a new opportunity to obtain a new or a second PPP loan. We'll talk about that. And also, there's a major set of changes to the employee retention credit. And one of the most significant aspects of that is that the employee retention credit, which is a very big deal, was originally not available to organizations that obtained a PPP loan. Under the new law, it is now retroactively available to PPP borrowers who meet the criteria. So because it's a really big deal, we're going to talk about those things, and then we're going to hit the very high spots of some other tax provisions and other economic provisions that were in the law of interest to nonprofits. Let's jump in with changes to the Paycheck Protection Program beginning on line 9 in your outline. Congress appropriated a total of $284 billion for this new version of the PPP loan program. Now we have what we're calling now first draw, which is the original PPP loans. We're going to now call those PPP1, and we have the opportunity to get a second loan or a second draw of a PPP loan, and we're now calling those PPP2 loans. So those are the terms I'm going to use as we go through it. Big picture overall changes that were made to the PPP program, including retroactively to the original PPP1 loan program, churches and religious organizations. The law solidifies and affirms the accommodations that were made by and that were published in guidance by the SBA. As you will remember, there were some major accommodations written into the guidance by the SBA respecting the rules, respecting the role of religious organizations, churches in America, and their ability to participate in these programs. Congress solidified and affirmed those positions. Line 18, a new provision is that the affiliation rules are waived for both PPP1 and PPP2 loans for nonprofits that are in the radio and television broadcasting arena. So if you're in that arena, that's a big deal in terms of your eligibility. Now, the affiliation rules deal with whether you have to add the employees of affiliated organizations all together in determining whether you're eligible for the loan. And religious organizations under the original law and guidance were given some flexibility in that regard. The new law gives radio and television broadcasting organizations some new flexibility there. Line 21, regarding the timing, the SBA has allowed lenders in small communities, small community lenders, lenders serving underserved elements of the population to have already begun accepting applications. The whole application process for PPP1 and PPP2 goes wide open with the SBA starting tomorrow, the 19th. So all lenders, all borrowers, all types are able to apply through the SBA site. Now, your particular lender may not be ready by tomorrow, but the SBA is opening the portal to all lenders for all borrowers starting tomorrow. Now, the requirement, we're at line 25 of the first page, the requirement that at least 60% of the loan forgiveness amount must be payroll costs. That continues to be the case both for PPP1 and PPP2 loans. Looking at the top of page 2, changes related to the original loan program, PPP1. There's a new loan application for those who are going to obtain a loan. There's a link in your outline right there in the PDF. It'll take you straight to it. There's also a new set of consolidated SBA rules where the SBA combined a lot of their previous guidance into a single place. There's a link in your outline that'll take you there. The maximum loan amount under the PPP1 program is still $10 million. Now, this one's very interesting. The law retroactively, line 30 on our outline, page 2, the law retroactively defines a seasonal employer. You may remember that in the original guidance, we had some rules for seasonal employers, but we didn't have a definition. Well, now we have a definition, and the definition is retroactive. So a seasonal employer is an employer which either, line 30, operates for no more than 7 months in a calendar year, or had gross receipts, and we're going to talk about that term, it's a very important term here in a minute, gross receipts or revenues in any 6 months in the prior calendar year that were no more than 1/3 of the gross receipts for the other 6 months of that year. So this is a new and specific technical definition for the term seasonal employer. Now, some new rules for the seasonal employers. And the biggest one is that it expands the period during which seasonal employers are permitted to calculate their average monthly payroll costs. You remember under PPP-1, you're able to borrow 2.5 times your average monthly payroll costs. Well, seasonal employers were given a little bit of flexibility in terms of how they measured or how they determined their average monthly payroll costs. Well, their flexibility has been significantly expanded here, and now seasonal employers are permitted to select any consecutive 12-week period beginning February 15th of 19 and ending February 15th of 20. They can pick any 12-week period in that window and determine their average monthly payroll costs there. That could significantly affect the amount that some organizations could borrow. So because that's true, this law allows a seasonal employer who got a PPP-1 loan to apply for an increase in its original PPP loan amount. If the new rules allow them to borrow more, then they can apply for more under this program. Their original PPP loan must still be outstanding, meaning it cannot have been forgiven yet. So that's a big deal for seasonal employers. It's not abundantly clear what other implications this retroactive definition might have for organizations that deemed themselves to be seasonal employers, even though there was no definition. We think practically speaking, it won't hurt any organization that did that because the guidance says that the forgiveness rules apply as in effect at the date of the loan forgiveness application. So assuming you've already submitted your loan forgiveness application, we believe that there's likely to be no effect. If you haven't submitted it, I think we're going to have to stay tuned to see what impact, if any, this change might have on whether an organization is deemed to be a seasonal employer who thought it was a seasonal employer based on the fact that there was no real definition. Let's look at line 45. The new law retroactively adds some expenses to the categories of expenses that are permissible under PPP loans. And the first one that we're going to, by the way, these new changes, these additional categories of expense are now permissible for all PPP loans, no matter when they were taken out. So the original loans, the new loans, retroactive, forward, all of them are inclusive. So at line 50, we've now clarified that in addition to employer paid regular health insurance, regular group health insurance costs, we can now include employer paid group life, group disability, vision, and dental that are paid for by the employer. Now, in addition to the fact that these are additional costs, what's also important is that these are in the payroll cost category, which is, of course, the golden category of forgivable expenses, because that's the category that has to be at least 60% of our forgiveness amount. So we've got some additional items that can be counted there retroactively. Top of page 3 in your outline, line 53, we have some other categories. Covered operations expenditures, which basically is a variety of types of operating costs. I apologize for the incredibly terrible way that this description is written. It is copied verbatim from the guidance. Whoever did write it apparently has never come across the concept of punctuation. But I think it is really just an overall kind of operating administrative expense category. Line 58, covered property damage costs. If you had property damage or looting due to public disturbances in 2020 that are not covered by insurance, that's now an includable cost. Covered supplier costs, the definitions provided there. Covered worker protection expenditures, if you're buying protective equipment for your employees or making adaptive investments, meaning that you're making health-related improvements to your workplace, those are all costs that are permissible. But remember, we still have to meet that 60% of payroll costs. The forgiveness amount has to be at least 60% payroll costs, notwithstanding the fact that we now have some additional non-payroll cost categories. Looking at line 69, it allows the borrower to elect the covered period beginning on the loan funding date and ending on any date of the borrower's choosing that occurs between 8 weeks and no more than 24 weeks after the loan funding date. You may remember that under previous guidance, we either had an 8-week covered period or we had a 24-week covered period. The default was 24, we could elect to have 8. But in essence, because borrowers were permitted to apply for forgiveness, if they were under the 24-week covered period, they were permitted to apply early. And so for all practical purposes, this was already the rule. But now, more formally, the borrower can pick an ending date for their covered period anytime in that 8 to 24-week period. Line 72, the SBA is going to produce a simplified borrowing application for PPP loans for borrowers of loans under $150,000. Congress has said that it's got to be a one-pager. As of late last week, we have not yet seen it, but we're expecting it to be published any moment. Line 85, the new law prohibits eligible entities that receive a grant under the Shuttered Venue Operator Grants Program from obtaining a PPP loan. We're going to talk just briefly about that in a moment. But if you get a grant from that program, you're not eligible for a PPP loan. Line 87, the law now allows certain 501c6 organizations to qualify. This is your business leagues, trade and professional associations, and the like. And then here's a real whopper, line 90. Line 90, borrowers who previously returned or did not accept all or part of their PPP loans may reapply for the maximum amount applicable. You know, some borrowers, well, they got nervous about the rules related to that good faith certification about economic uncertainty, and they simply decided to return the money. Then the SBA came out and said, we're going to deem every borrower under $2 million to have made that certification in good faith. Some organizations regretted the fact that they returned the money. So this allows those organizations to reapply, but we have to keep in mind, top of page 4, line 92, the requirements still include the requirement to make that good faith certification about current economic uncertainty, making the loan necessary to support ongoing operations. All loans that are not forgiven will have a 5-year maturity and will bear interest at 1% annually. Now let's talk about the PPP2 loans, this opportunity to have a second loan. The loan application is available. The link is there in your outline on line 95. The new consolidated rules, the link is there as well on line 96. Now, there are some different rules here for PPP2. First of all, one of the differences is line 98, the maximum loan amount is $2 million. The rules are generally similar, but there are some differences. So let's talk about the differences. Looking at line 104, the maximum employee count for PPP2 is 300 employees, not 500. 500 was PPP1, and PPP2 is a cap of 300 employees. Also, you must have already gotten a PPP1 loan and used it fully before you receive money under a PPP2 loan. Now, here's a quantifiable test, which of course did not exist under PPP1, and that is that you must demonstrate at least a 25% reduction in gross receipts or revenues in any completed calendar quarter of 2020 as compared to the same quarter in 2019. And for organizations that were not in operation for all of 19, they've got some special rules to tell you how to deal with that. So basically, in any calendar quarter of 2020, if your gross receipts, we're going to talk about what that means in a moment, had declined by at least 25% as compared to that same quarter in 2019, then you meet the criteria for borrowing under PPP2. Page 4, line 115, the term gross receipts. It's defined by reference to the Internal Revenue Code and essentially the Treasury regulations. It is all forms of gross revenue and income. You can read the details there. There's a complete description that continues over onto the top of page 5, but it is gross revenues, gross proceeds from all types of activities. So keep in mind, if you sell things, it's the gross revenue from selling them. If you sell assets, it's the gross proceeds from the sale, not the net income, not the gain. So it's gross at every level. Now, here's a really interesting observation. If you look at line 130, the rules, unless new or different guidance comes out, do not make a distinction between restricted and unrestricted contributions with respect to nonprofits. That could be a good or bad thing depending on your facts, but here's how it could be a good thing. Let's think about a scenario where, let's say in 2019, maybe your organization had a big giving campaign. Maybe you had a big building campaign or a big just giving campaign for a special purpose. And that was not there in 2020. So that alone could be a reason for, in 2020 for your gross receipts, your revenues to be down significantly in a given quarter or multiple quarters in 2020 as compared to 2019. There's no distinction in the guidance today that acknowledges that you might have some special giving campaign. Now, of course, you still, even if you meet the criteria in that regard, you still have to make that good faith certification that current economic uncertainty makes the loan necessary to support ongoing operations. But that's a point that you might want to think about in terms of just qualification. Now, one other really important point here regarding what constitutes gross proceeds. Congress made it clear, SBA has made it clear in the guidance that the loan forgiveness from PPP-1 is not included in gross receipts for measuring for this purpose. So gross receipts does not include the forgiveness of the PPP-1 loan. Line 133, we've already talked about the fact that that good faith certification must still be there under PPP-2. Line 137, loan terms. It's essentially the same deal as was the case with PPP-1, and that is the maximum loan amount is 2.5 times the average monthly payroll costs for the organization. But note that the measuring period is a little more flexible. It can either be, and we're talking about the measuring period for determining your average monthly payroll costs. It can either be the 1 year, the 12-month period prior to the loan date, or it can be the calendar year 2019, or it can be the calendar year 2020. So you would obviously want to look and see what would give you the largest opportunity to borrow using each of those three options to determine your maximum loan amount. And then there's an overall maximum, line 141, of $2 million. These PPP-2 loans cannot exceed $2 million. PPP-1 had a limit of 10 million, as you will remember. Line 142, seasonal employers, same, this is what we talked about earlier, the same deal. You can calculate your maximum loan amount based on any consecutive 12-week period during that window of February 15, 19 to February 15 of 2020. What that means is that you can take any 12-week period in that 1-year window, and you can use that to calculate your average monthly payroll. And then you would multiply that result times the 2.5 times to get your borrowing base. There are rules under line 144 for organizations that are newer in terms of how they calculate the monthly payroll costs. Note that you still had to have been in operation on February the 15th of 2020 to qualify. And there are some new special rules, line 146, for organizations with multiple locations that are eligible entities under PPP-1. This is generally applicable to hotels and restaurants, and for the most part isn't likely to affect nonprofits. Line 148, an entity can only have one PPP2 loan. In terms of loan forgiveness, line 149, the rules are identical to PPP1. The same deal. You can spend the money on all of the same types of costs that are permissible. We now have a somewhat expanded list, as we talked about earlier, of permissible expenses and payroll costs, as that term is defined, and now slightly expanded to include those additional group health type and life and disability costs. Payroll costs must still be 60% or more of the forgiveness amount. Lender eligibility, all lenders that could make PPP1 loans are permitted to make PPP2 loans. So now let's go to the top of page 6 and line 157. Just for convenience purposes, we have recapped here the permissible costs now as retroactively amended by the CAA for either PPP1 or PPP2. They are the same. Permissible costs are the same now, retroactively amended under either program. I'm not going to walk through these definitions in detail, but the first category is payroll costs, and the elements that are included in payroll costs or are allowable in payroll costs are listed there. And you'll note that on line 170, we have that expanded definition to include group paid life, disability, vision, and dental, where the employer pays for those costs. We also, so that category payroll costs, that whole category is what must be at least 60% of your loan forgiveness amount. And then the other categories there: interest, business lease or rent payments, utilities, covered operations, covered property damage costs, covered supplier costs. Continuing on to page 7, covered worker protection expenditures. Those round out the list of permissible expenses that can be included. And as line 195 says, the requirement that at least 60% of the forgiveness amount must be payroll costs. We've covered that now a few times. So that's kind of a wrap with respect to the big changes to the PPP program. We're expecting that certainly some nonprofits will qualify. I have already talked with some of our clients who have thought about it and looked at the numbers, who believe that they did indeed. When you look at the definition of gross receipts, they did indeed have at least one calendar quarter of 2020 where gross receipts had decreased by 25% or more as compared to 2019. And you take into consideration all factors, that includes restricted giving and the like, and you ignore the PPP1 loan that you got and you ignore its forgiveness. So organizations where that's true and believe that they need the funds due to the current economic uncertainty should consider applying under PPP2. All right, now let's shift gears to another very major change in the law from the CAA, and that is the change related to the employee retention credit. Most nonprofit organizations paid little or no attention to the employee retention credit previously because the rules were and the law was that if you got a PPP loan, you automatically were disqualified from the employee retention credit. So as soon as we said that in our prior webinars and in our prior educational information, you know, organizations that pursued a PPP loan were like, yeah, yawn, I'm out of this, doesn't matter to me. Well, we need to be paying attention now because Congress has retroactively stated under this new law that PPP borrowers are eligible for the employee retention credit, assuming they meet the other criteria. So that's alone is a huge change, and it is retroactively true back to early 2020. So now there is one proviso, and that is that the wages that were used to fund for the PPP loan, in other words, the proceeds from the PPP loan that were used to fund wages, those wages can't count in calculating the employee retention credit, but we're going to see in a moment that that might not make a lot of difference in terms of how the credit is calculated. Additionally, in addition to expanding the credit to be available to PPP borrowers retroactively, the law extended the applicability of the credit. The credit was originally set to expire December 31 of 2020. I'm on line 201 of our outline. And it was extended through June 30 of 2021. In addition to that, the size and the scope of the credit were increased for the first 2 quarters of 2021. In other words, the size of the credit was improved, and the eligibility requirements for the credit were improved for the first 2 quarters of 2021. So because we now have this employee retention credit available, and we sort of have 2 versions of it. We have the version of it that's available related to wages paid from March 13, 2020 through the end of 2020. We have the rules that apply there. And then we have a new set of expanded rules and improved rules that apply to the first 2 quarters of 2021. So what I'm going to do here is I'm going to walk through those 2 sets of rules separately. First, I'm going to talk through the rules for the period from March 13, 2020 through December 31 of 2020. And remember, as we do this, that this new law has made this credit retroactively available to PPP borrowers. So first of all, what is the credit? We're in line 208. It is a refundable credit against the employer's share of the Social Security tax, which is, of course, the 6.2%, not the 1.45% Medicare tax that the employer pays with respect to wages paid to employees. Now, let me just say here that because this is a refundable credit, that term, anytime you see that term, that just means it's money from the government. It really doesn't matter what vehicle the government uses to give you this credit. In this case, they just happen to choose the employer's share of Social Security tax. But what it means is that if you qualify for the credit and you calculate the credit, the first thing you do is you reduce to 0 your employer's share of the named tax, in this case, the Social Security tax. But once you've reduced that to 0, you still get the excess as a refundable credit. So it's just money from the government. It really doesn't matter. They just use the Social Security tax as a vehicle, meaning that's the way you get it. You get it by making that claim through your payroll tax returns. So if you qualify for the credit and you calculate the credit amount, my point is you will get the money. It doesn't matter what the amount is of your employer's share of the Social Security tax for the relevant period, you will still get the money. Okay? You just do it through your payroll tax returns. Now, there's some special rules regarding eligibility. Let's look at line 217. Eligible employers must have carried on a trade or business during 2020 and satisfy one of 2 tests. Well, that first part's very easy because the law says that all operations of tax-exempt organizations that are exempt under 501c, any organization described in section 501c, which of course includes churches and tax-exempt ministries and schools and the like, who are all C3s, all of your operations are considered a trade or business for this purpose. So the first one's easy. We don't need to worry about that one. Then we have to satisfy one of 2 tests. So let's take a look at the top of page 8 and let's see what those 2 tests are. And this is an either or. So either 1, we have fully or partially, really key word right there, or partially suspended business operations during any calendar quarter of 2020 due to orders, another very key word, from a governmental entity limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes. So I'm going to talk more about this in a moment, but let me just reiterate what we've said there. If we fully or partially suspended operations during any calendar quarter of 2020 due to orders, meaning mandates. This is not, the governor coming on television and saying we recommend that all businesses do this, or we recommend that all churches do that. We're talking about mandates, orders from either your governor or from your county or local officials, some governmental entity that ordered you to either fully or partially suspend operations. Now, if you had that happen, then you qualify. If you had that happen during any calendar quarter of 2020, then you qualify for the credit because this is either or. All right, let's go to the second of the either ors. Or you experience a reduction in gross receipts of at least 50% in any calendar quarter of 2020 as compared to the corresponding quarter in 2019. Now, thankfully, most churches and ministries that we've worked with did not have a reduction in gross revenues of that amount. Now, remember, we're talking still about the rules that apply for this period of March 13 of 2020 through the end of that calendar year, 2020. There are some new and much better rules that apply in the first 2 quarters of 2021. So hold on, even if so far you're thinking, well, we don't qualify. Hold on. But for the rules for the 2020 period, these are the criteria. Now, for this purpose, look in line 233, 234. Gross receipts are defined in the same manner as for the PPP2 loans. So we already talked about what that term means, and it does not appear to make any distinction between restricted and unrestricted contributions with respect to nonprofits. So you've got those either or criteria there, and if any time during 2020 you were forced by government mandate to partially or fully suspend operations, then you qualify for some period of time. Now we have an example here on line 237, giving you just an example of how to calculate the decrease in gross receipts. The rules say that if that happens, if you have a calendar quarter in 2020 where you meet that criterion, where at least 50% gross receipts reduction in that quarter of 2020 versus 2019, then you are eligible for the credit during that quarter, and you're eligible for the credit until you have a quarter where the gross receipts for that quarter exceed 80% of the amount for the corresponding quarter in 19. So in this example, this particular organization qualified in the first quarter because it had that big of a reduction, and then it continued to qualify in the second quarter, even though in the second quarter its gross receipts were 83% of the amount in 2019. They still continue to qualify for that second quarter because of the way the rules are written. Now let's look at line 248. How do you calculate the credit if I qualify? The credit is 50% of the first $10,000 in wages per employee, and this is during the period of March 13 to December 31. So it's 50% of the first $10,000 in wages per employee during the quarters that you are eligible. But the maximum amount for that whole period from March 13 through the end of calendar year 2020 is 50% of the first $10,000 of wages per employee. And wages for this purpose, line 251, are generally FICA wages, so clergy compensation would not normally qualify. Let's take a half look back to line 249. We note that wages paid with PPP loan funds that are forgiven cannot be used as a basis for the credit. So depending on when your eligibility happened, that may be relevant to your calculation. Now, let's look at line 253. The credit is reduced by any credits under the FFCRA or for any other credits that are applicable to the same wages And then, as we said earlier, line 256, to the extent that the credit exceeds the employer's Social Security tax due, the excess is just a refundable overpayment. Now, here's another really interesting aspect to this rule. Line 258. For employers with an average, again, this is the 2020 version, for employers with an average of more than 100 full-time employees in 2019, only the wages that are paid to employees for periods during which they are not working due to the hardship, due to their partial or full shutdown, or due to their revenue decline, only the payments that are made to employees that are not working for those reasons count towards the credit. But the alternative is true, and that is for employers with an average employee count of 100 or fewer during 2019, going to the top of page 9, then the wages that you pay to all employees during that period count towards the credit. That's a really big deal. And there are some rules regarding possible aggregation of employee counts with affiliated entities. There are different rules than the PPP. If that's relevant, you'll need to look at that. The employee counts are made using the same methods that apply for employee counts under the Affordable Care Act. We have a link to some guidance there from the IRS. So if you're close, that would make a difference. And again, line 271, this credit applies to wages paid after March 12th, 2020 and before January 1 of 2021. The IRS has a list of frequently asked questions. It unfortunately has not yet been updated for changes that were made to the credit under the CAA. When they do, that link is there, and that's where the IRS will add the additional guidance. Now let's talk about some really significant observations here. Thankfully, very few churches and schools had that kind of revenue drop, in excess of 50% in 2020 as compared to 2019. So for now, we're going to ignore that aspect of it. But lots of organizations had mandatory full or partial shutdowns of their operations or group meetings at some point during 2020, and as a result may very well qualify. If you look at churches, schools, and other organizations like that, there are certainly some jurisdictions where they were ordered to stop having meetings, even where churches maybe were not ordered to stop having worship services altogether. Maybe they were ordered to not have other meetings or other types of gatherings. So I think any reasonable interpretation of that would be that if you were ordered to stop conducting certain of your activities, that would seem to constitute a partial suspension of operations. There is an IRS FAQ, looking here at line 292, there is an IRS FAQ that says if an employer is able to continue operations comparable to its operations prior to the closure by requiring its employees to telework, that employer's operations are not considered to have been fully or partially suspended as a consequence of a government order. But there's a key word there, and that is comparable. It would be my belief that churches who had to shut down children's activities, recreational activities, fellowship activities, or any number of other, classroom activities, that's certainly not comparable. Even if they were able to have online worship experiences, that is certainly not comparable to pre-closure operations. The same would be for schools. Schools that were able to have virtual classes, that might be true, but many schools were ordered to shut down extracurricular activities, athletic activities, other physical gatherings. And so I think any reasonable interpretation of those rules would show that that was a partial shutdown. The key would be whether it was mandatory, whether it was due to orders for any period of time. Where it was, taking a look on the top of page 10, where it was, the organization may very well qualify. So let's take a look. And by the way, the credit is half of the first $10,000 of wages that were paid during the applicable period. And let's look at line 306. We note here that there's a really big difference, a radical difference between the treatment of organizations during 2020, where they had 100 or fewer employees in 2019. There's a big radical difference because for those churches, the wages paid during the applicable eligibility periods to all employees count. For churches or other organizations with more than 100 employees during 2019, only the wages paid to workers who were not working due to these hardships count. So radical difference in the treatment. Now, let's look at an example that begins on line 316. I'm not going to walk you through all the details. I just want to point out how big of a deal this credit could be to an organization that qualifies. This example is for an organization that has 85 employees, 85 full-time employees, and then we just happen to use a church. But if this church had 85 full-time employees and the credit is available to them, in other words, they meet the criteria for a period of time, and they paid wages to employees of at least $10,000 each, the credit is 50% of that amount. We're assuming here, and by the way, we are expecting guidance. You'll note in line 319, we're expecting guidance that from the SBA that allows organizations to ignore wages that were paid with PPP loan funds in calculating the credit. What I mean by that is that you can't count the wages that you pay with PPP loan funds toward the credit. But what we're saying is that we believe that even though the rule says that the credit applies to the first $10,000 in wages that you pay during the eligible period, what we believe they're going to say is that for determining what are the first wages that you paid, you can ignore the fact that you paid some wages with the PPP loan funds. We believe that's what's going to happen. So in this example with an 85 employee church, let's just jump to the bottom line. If that church's employees were paid an average of $42,000 a year, it really doesn't matter what the amount they're paid is. What matters is the amount that they're paid during the eligible period. And if they paid the employees at least $10,000 during the eligible period, they qualify for the credit, which is half of that amount, and that would be $5,000 per employee. So if you have 85 employees at $5,000 per, that's a $425,000 credit, which is refundable, which, as we've now said several times, simply means that's money from the government. It is real money. If you qualify for that credit, even for a church, with 85 full-time employees, which would be a large church for sure, but that's a sizable credit. You can mentally kind of scale it depending on the size of your organization and get an idea of what that credit amount might be if indeed you qualify. Looking at the top of page 11, note that if Oak Church, in our example, had an average of more than 100 employees in 2019, then the credit would only apply with respect to wages paid to the employees in our example who did not provide services during the eligible periods due to the hardship. So radical difference in the treatment there based on the size of the employee base. Okay, now those are the rules for 2020 for the employee retention credit. Let's talk about the changes that were made, the improvements and expansions that were made to that credit as it applies to the first 2 quarters of 2021. So there are some big changes. There are also some things that are the same. Let's look at line 366. Eligible employers must have carried on a trade or business during 2020. We've already talked about that nonprofits, that's an easy one. And they must meet one of 2 tests. Okay, but now here are the two tests, and they are different. Test number one, and again, this is an either or. Number one, have fully or partially suspended business operations during either the first or second quarter of 2021 due to orders from a governmental entity. Same idea, but either quarter of 2021, if you have suspended your operations either fully or partially due to government orders, then you qualify. Or here's the other criteria. You experience a reduction in gross receipts of at least 20%. It was 50% in 2020, so now it's improved. It's at least 20% in either the first or second quarter of 2021 as compared to the same calendar year, of 2020. I apologize. Let me say that again. You experience a reduction in gross receipts of at least 20% in either the first or second quarter of 2021 as compared to the same calendar quarter of 2019. So note that the reference year is still 2019, but we're looking at our gross receipts, and we've already defined that term, in the first or the second quarter of 2021. And there are special rules that apply to organizations that were not in operation during the applicable quarter of 2019 and for seasonal employers. So now let's kind of think back to what we said earlier about our definition of gross receipts. And we remember that the rules do not appear to make a distinction between restricted and unrestricted contributions. So now the criteria for qualifying is that we had one quarter in the first two quarters of 2021, either of those first two quarters, in which our gross receipts during 2021 are reduced by at least 20% as compared to the same quarter in 2019. Now, remember what I said earlier, if you had like a major giving campaign in 2019 and you didn't have that in 2021, that alone might be a reason that you could have gross receipts that are less than in 2019 and possibly 20% less or more. And if that's the case, you would qualify for the credit. Now, some folks might say, well, now wait a minute. Even if that's technically true, I'm not sure that I want to claim that credit. And certainly if that's an organization's perspective, every organization has the right to, apply or not apply for the credit. I would say it's a little bit like, buying a new energy efficient water heater or air conditioner. You qualify for a credit if you buy certain equipment of a certain type. Whether you want to apply for it or believe you should, that's up to you. But this is a mechanical requirement that is written into the law. This is not saying that you meet some need or whatever. This is just saying if you meet this mechanical requirement, then you qualify for the credit. Let's look at the top of page 12. I have an example here, and note that the way the 2021 version of this credit applies, it is quarter by quarter, which is different than the way it worked in 2020. The 2021 version of it is quarter by quarter. So we look at each quarter and we calculate the credit separately for each quarter of 2021. The credit amount, line 393, is 70% of the first $10,000 in wages per employee paid during each of the first two calendar quarters. And so if you qualify during the first quarter of 2021, then the credit amount is up to $7,000 per employee that you pay. If you qualify again in the second quarter of 2021, the maximum credit is another $7,000 per employee that you pay, for a total possible credit amount of $14,000 per employee that you pay. during the period in which you're eligible. The wages, just as with the 2020 version, are FICA wages, so clergy comp is normally not going to be included. The other rules are essentially the same, but let's look at line 403. Here's that quirky rule about, if you have more than this many employees in 2019, then only the wages that you paid to the people who were not working count. Well, they changed that in a really big way here. And now under the 2021 version of the credit, that threshold is now 500 full-time employees. So for employers with an average of more than 500 full-time employees in 2019, only the wages that you pay to employees during these quarters of 2021 while they were not working due to these hardship issues, only those wages count. But if you had 500 or fewer employees in 2019, then all of the wages that you paid to all of your employees count if you're eligible. That is a massive, radical difference in treatment between organizations, on either side of that threshold, but it's a really big deal in terms of the impact on the amount of the credit. In terms of what else is different, let's take a look and let's move down to page 13, line 449. And it's the same idea here is true. If you had a full or partial suspension of operations during either quarter of the first 2 quarters of 2021, same idea. You're still under orders to only partially operate your church, your ministry, your school, then you could qualify that way. Or if you had a reduction of your revenue base, of at least 20%, then you can qualify that way. But if that's true, then you could have a credit amount of 70% of the first $10,000 in wages paid to all employees during that applicable quarter. Now, let's take a look at the example that's on page 14. The example on page 14, I'm not going to walk through the details. I've just made an assumption here, and this is a church that has 285 full-time employees, okay, in 2019, and it qualified for the credit for just one quarter of 2021. And it qualified for the $7,000 per employee. Well, if you do those numbers, and you can look there in line 476, the credit amount of $7,000 per employee for 285 employees, that's $1,995,000. That's $2 million of refundable credit or money from the government. That is a huge, huge deal. That's one church, 285 employees that qualified for the credit for one quarter. Okay, so this is a really, really big deal. And for organizations who may qualify, you really need to run down your situation to be sure. We've already had organizations reaching out to us saying, hey, help us figure this out because the rules are very technical and because the stakes are very high. This is a massive credit for those organizations that qualify. All right, let's take a look then. Top of page 15, I'm just going to mention, I talked about this earlier. I mentioned that if you have one of these grants for shuttered venue operators, then you're not going to qualify for the PPP loans. And this is grants to organizations that had to shut down live venue operations like theaters, performing arts centers, and the like. So if you're in that list there, you're going to want to take a look at that and possibly pursue those grants if you are eligible. Page 15, line 515, other key provisions that were relevant to nonprofits. Very quickly, I'm just going to mention these. There's a new separate employee retention credit for employers that are in a qualified disaster zone. It's 40% of qualified wages up to $6,000 of wages. So if you're in a disaster zone, you'll want to take a look at that. Line 519, there's going to be an extension of certain federal unemployment assistance to employees through March the 14th of 2021, including assistance for nonprofits who pay their state unemployment obligations under the reimbursement method. Line 522, where President Trump issued an order allowing employers to defer the employee share of their Social Security taxes during the latter part of 2020. The law extends the period through which those have to be repaid, and that those amounts can now be repaid through December 31 of 21. Line 531. This just clarifies for businesses and nonprofits that have unrelated business income that your PPP loan forgiveness is not taxable and all the expenses that you incur with it are deductible. Line 538, it extends the refundable payroll tax credits for FFCRA into up to March of 2021. So if you pay people who qualify for that during the first quarter of 2021, you still qualify for the credit. It did not continue the mandate to pay people under those criteria after 2020. Line 543 says that the charitable contributions, the limitations increase that we saw in 2020 are continued and expanded just a bit. Those who don't itemize in 2021 now can deduct up to $300 for an individual, $600 for a married couple filing jointly. That was $300 for either in 2020. It's now $300 and $600 for 2021. Line 547, the increased limits on charitable contribution deductions for individuals, which in 2020 was 100% of adjusted gross income, and for corporations was 25% of pre-tax income. Those higher limits that applied in 2020 are extended through the end of 2021. And then finally, business meals provided by restaurants are fully tax deductible as business expenses for businesses and for nonprofits that have unrelated business activities. So there you go. We've got a few minutes now to cover questions. I know we've covered a lot of material, but there's a lot there, and we wanted to make sure that you were at least aware of it all in the time that we had. So Michael, what questions do we have?
All right. Well, thanks, Mike. You did an excellent job getting through a lot of complex material. We do have a lot of questions that came in. We'll take just a sample of those. I'll kind of put these into categories. These are kind of related to PPP. Here's a clarifying question. It says, we're a Bible college. If we had a better giving year in 2020, unrestricted and restricted, than 2019, does that make us ineligible?
Well, that would make you ineligible for the PPP2 loans for sure, because one of the criteria there is that you had a decrease in gross receipts in 2020 as compared to 2019, of the 25, the more than 25%. So that would make you ineligible for PPP2. And
Okay.
Michael, I'm good going for, until say 2:15 if you all are. We'll cover as many as we can here.
Okay, that sounds great. We appreciate your extra time. We'll do that. Another question here, it says, we can show a technical loss for Q2 and Q3, but in reality had the best year ever. Are we eligible to apply?
So I'm not sure whether they were referring to the PPP2 or the employee retention credit. We're talking about the PPP?
Yes, PPP.
Well, I mean, there's two basic criteria there. There's the quantitative criterion, regarding the at least 25% reduction in gross receipts during any calendar quarter. That's a mathematical question that, either you did or you didn't. And then there's still the requirement that you have to make a good faith certification about the current economic uncertainty making the loan necessary to support ongoing operations. So I think that would be a more subjective, qualitative decision, it sounds like, for that organization.
Got it. Okay. And these are also PPP related questions. These came from our hashtag AskECFA on Twitter. I think the first one, Mike, you already clarified. Do gross receipts include the amount of forgiveness of the PPP loan, which I know is covered there in the handout? But another question, if we missed it, is the 300 employee requirement an average headcount over the year? The reason why we're asking, our headcount increases over the summer due to seasonal staff.
Yeah, so at the moment, the measurement period for the 300 employee count is not abundantly clear, but as best we can tell from the guidance, it is going to be either the calendar year 2019, the calendar year 2020, or the 12 calendar months preceding the date of the loan application. And but it is, you're going to calculate your average employee count the same way you were required to under PPP 1, and it's going to be over a 1-year period unless you are a seasonal employer, and then you can pick any 12-week consecutive period between February 15 of 19 and February 15 of 20 to determine that that average employee count for the borrowing base. But as far as your eligibility with the 300 employees, pretty much every employer is going to have to look at, one of those 12-month periods. Now, there are some special rules for seasonal employers. We're still waiting to see exactly, because it's not even clear for the non-seasonal employers exactly what the measurement period is there, but we believe that's the way that's going to work for the non-seasonals. For the seasonal employers, we're going to wait and see what, if anything, they say to clarify in terms of that employee count.
Got it. Okay. No, that's very helpful. Our next question is the calendar quarter any 3-month period, or just like, for example, January through March, like I guess calculating based on typical calendar quarters, or is it any 3-month period?
Yeah, when they say calendar quarter, they're literally talking about January through March, April to June. That's what they're talking about.
Okay, excellent. Let's see here. How does the sale of an asset affect gross receipts for determining eligibility for PPP2? If a building was sold at a loss, are we able to reduce gross receipts by the amount of the loss?
No, if you look in the outline, the it's the gross proceeds from the sale of assets. In fact, on line 27, that's stated there, and that's right out of the Treasury regulations. The gross amount received from the sale of assets without reduction for cost or other basis and expenses of sale. So it's the gross proceeds from the sales of assets.
Great. And I know, Mike, too, just kind of moving on to a slightly different area, but within the realm of PPP, even with the PPP1 loan, some of the organizations that received the loans for over 2 million, I know there's some concerns related to the extra forms that needed to be filled out, and also what would SBA do with the information that's on the form. Can you speak to that a little bit for those that had loans that were over 2 million?
Yeah, so the SBA has created these information gathering forms for organizations whose loan amounts are 2 million or more, and they are fact gathering questionnaires that generally relate to how the organization's financial operations played out after they obtained a PPP loan. And they include a number of questions about a number of things. They've raised a lot of concerns. One of the reasons they've raised a lot of concerns is because there was no economic, quantification type test in connection with borrowing under PPP1 or eligibility for forgiveness. And so even though the SBA is asking these questions, people are saying, what difference does it make whether my revenues were up or down? That wasn't part of the deal when we borrowed under PPP1. So, those concerns are still there and they're very real. There have been several lawsuits filed against the SBA in connection with issuing and requiring those questionnaires. We've yet to see what the outcome of that, but these are lawsuits by very large groups of organizations and businesses. So I think time will tell how that's going to shake out. And perhaps more importantly, time will tell whether the SBA will be permitted to ask questions like that. But ultimately, it's about what the SBA does with that information and what, if anything, the SBA does to create some kind of criteria that did not exist in the law or the rules prior to their engagement. So we just are really under a wait and see mode there to see how that shakes out.
Okay, good. Appreciate that perspective. The next question is, if a nonprofit has unrealized gains on investments, like for instance in an endowment, do unrealized gains, not interest or dividends, but just gains in value, count in gross receipts?
You know, you would want to talk with your um, whatever organization this is, you want to talk with your advisors to make sure of the right answer to this for you. But um, in my estimation, it's likely that unrealized gains will not count as gross receipts, as that term is defined technically. But you'll want to make sure you get an opinion from your advisor for your situation.
Great. Okay, another one here. Do payroll costs include employees only who are subject to tax withholding, or does it also include contractors with Form 1099s?
Well, under the PPP loan arrangements and criteria, that was a source of an area of confusion at the beginning. But as things shook out further, the SBA took the position that payments to independent contractors are not counted in payroll costs for employers because self-employed individuals are permitted to get their own PPP loans. So that's essentially the way that shook out.
Okay, helpful. Yep. Next question says our FTE headcount was decreased by about 35% since pre-COVID and will probably stay that way for many months. Is there any issue with applying for the PPP loan? I realize that it will not be all forgiven, but are there any other issues or limitations? And it's not clear from this question. Oh, actually, subject line says PPP loan question draw 2. So I think we're referring to the PPP 2 in this question.
Yeah. Well, I mean, if you meet the criteria for obtaining the loan, I mean, that's question number one. And then how you calculate your forgiveness calculation would be its own issue. I think you'd have to have somebody help you look at your specific situation and sort of run numbers to see how that might shake out. But you know, the mere fact that you've had a reduction in force is not going to disqualify you from obtaining a loan. And depending on how the forgiveness calculation works and what the relevant period is, it might not impede your forgiveness. Keep in mind, under the PPP2 loan, you have a new covered period. So the new covered period is going to be from the date of the new loan forward, not the prior period. So whatever reduction in force you had prior to PPP2 is not likely to adversely affect your forgiveness.
Perfect. Okay, we'll squeeze in one last one here, Mike, and that is just questions on some guidance. Where can one find the best information to direct an organization on how to or where to submit paperwork for PPP1 forgiveness? This person says banks are taking a hands-off approach, but they receive the applications, not the SBA.
Well, if you have a PPP1 loan, which would be the only reason I would assume you would be interested in forgiveness, the same lender who made the loan is supposed to be the lender that processes your forgiveness application. And so that is the one and only place you should start, is the lender who helped you with the loan.
Okay, no, that's great. And okay, I said that was the last question. One more, and that is for
That's
this
okay.
for this handout. I know you mentioned changes are coming. Where can folks? We'll have this posted on our ECFA page, but also on your website, Mike. Where do folks go to find the latest updates?
Okay, so our webpage, as you mentioned, would be a place to go. We will update that periodically as significant new developments occur. And then, of course, the SBA sites would be a great place to go for guidance. The links that we provided to the new consolidated rules, that would be a great place to start with the SBA, and they will likely be updating those rules in the days ahead.
Very good. All right. Well, that's a great place to land it. And again, Mike, thank you so much for the great presentation and the help on those questions as well. We've got just a couple more important announcements before we wrap up today's webinar. Thanks everyone for your patience and tuning in. We are excited to announce our next free webinar in just a couple of weeks on February 4th. The topic is managing a remote team securely and effectively, and we are pleased to welcome Thomas Tyler from Cape and Krause to help gain practical guidance on the topic of remote work. You can register for that webinar today. And then also, speaking of resources to navigate these times, you can find all the latest free COVID resources from ECFA, like today's webinar, surveys, and more on our special resources landing page at ecfa.org/COVID-19. And also, while I have this opportunity, I also want to say a very sincere thank you to many of our over 2,500 ECFA members who are represented on today's webinar. For other friends who are also with us today, now is a great time to take the next step in becoming ECFA accredited. During this COVID-19 season, ECFA is waiving the standard initial $500 application fee, and you can learn more about this opportunity by emailing me directly at president@ecfa.org. Well, that brings us to the end of today's ECFA webinar on what's new for nonprofits in the Consolidated Appropriations Act 2021. We hope this has been a meaningful time for you. You'll be receiving another email tomorrow with a link to the recording and other related materials. And again, I'd like to thank Mike Batts for his outstanding presentation and insights, and for each person who joined us today for this webinar. God bless you as you continue to shine bright the light of Jesus Christ in these times.